Hey everyone, welcome back to Corporate Decoder. Today, MSD Investment Corp just filed an 8K, and I am seeing a significant debt issuance that means a lot for their future strategy. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company just sold off a big chunk of new debt, and I want to break down exactly what that means for them and for anyone holding their stock. So, MSD Investment Corp, or the company as they call themselves, has filed this report to tell us about a new debt deal they've made. Basically, they've issued new notes, which is a fancy way of saying they've borrowed a lot of money. This new borrowing is for $300 million worth of notes that are due in 2029. They're carrying an interest rate of 6.375%. This is a pretty substantial amount of money, and it is important to understand why they're taking on this debt. The company says they plan to use the money to pay off other debts they already have, which can be a smart move to improve their borrowing terms, and also for general corporate purposes, which often means investing in new projects or companies. This new debt agreement is described as a third supplemental indenture. Think of an indenture as the contract for a bond or note. This is an update or an addition to an existing contract they had. This specific indenture adds the new 6.375% notes that are due in 2029. The notes themselves are described as unsecured, meaning they are not backed by any specific company assets. This usually means they carry a bit more risk for the lender, and thus the interest rate might be a touch higher to compensate. Now, when companies issue new debt like this, especially in private placements, which this seems to be, they often have to promise to eventually register that debt with the government so it can be traded more freely. That is where this agreement comes in. MSD Investment Corp has entered into a registration rights agreement. This means they've promised to file paperwork with the Securities and Exchange Commission, or the SEC, to make these new notes available for public trading. They have about a year to do this. If they don't, they'll have to pay extra interest, which is a penalty for delaying. This tells us they want these notes to be a standard part of their publicly traded debt. Let's talk about the money itself. That $300 million figure is the total face value of the notes being issued. This isn't profit, it is money they owe. The fact that they're taking on this much debt suggests they have plans for growth or a need to restructure their existing financial obligations. One of the interesting parts of this new debt agreement is what is called a change of control repurchase event. This means if certain things happen, like the company being bought out by another entity or a major change in its leadership, and at the same time, if the rating agencies like Fitch or Moody's downgrade the debt to below investment grade, the company might have to buy back these notes. This is a protective clause for the bondholders, giving them an option to get their money back early under specific unstable circumstances. This deal was done through something called a private placement, relying on an exemption from the usual registration requirements under the Securities Act. This usually means they're selling to sophisticated investors, like institutions or very wealthy individuals, who understand the risks involved. They then plan to exchange these privately placed notes for registered notes, as we saw in the registration rights section. Here is where it gets really interesting in terms of managing risk. The company has also entered into an interest rate swap. Think of this as a financial trade. They've got this new debt with a fixed interest rate of 6.375%, but their business, which they say consists mainly of floating rate loans, means their income can change based on market interest rates. To protect themselves from rising rates, they've used a swap. They will receive a fixed rate of 6.375% on the swap and pay a variable rate, which is tied to SOFR, a benchmark interest rate plus a spread. The goal of this is to effectively make their borrowing costs match their income streams, creating more predictable finances. This swap has the same $300 million notional amount and the same maturity date as the new notes, June 2029. It is a sophisticated way to manage financial exposure. The filing also lists the exhibits, which are the actual legal documents. This includes the original indenture from April 2025, the new third supplemental indenture, the form of the notes, and that registration rights agreement we talked about. These are the contracts that lay out all the nitty-gritty details. And finally, the report is signed by Brian Williams, the Chief Financial Officer and Treasurer. This shows that the company's finance leadership is aware of and responsible for this filing. So, what does this all really mean? MSD Investment Corp is raising a significant amount of capital through new debt. They're using this to refinance existing debt and likely fund new investments. The interest rate swap is a key move to manage the risk associated with their floating rate assets and fixed rate liabilities. It shows a proactive approach to financial management. However, taking on more debt always increases financial risk. If their investments don't perform as expected, or if interest rates rise dramatically beyond what the swap can hedge, they could face difficulties. The risk I'm watching is the company's ability to generate sufficient returns from its investments to comfortably service this new, larger debt load. What I'm actually looking for is how these new investments perform and whether the interest rate swap truly smooths out their earnings. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this analysis helpful, please hit like and subscribe for more. Join our amazing Discord community, linked below.